There is a lot of talk in the media about interest rates, mortgage rates, and inflation. Is the sky falling? Or is there an opportunity here? Fixed interest rates have increased from an historic low in February 2021 of about 1.5% to now hovering both sides of 5%. This is certainly a higher increase than most of us expected, and there are several reasons behind it. By most estimates, most borrowers should avoid selecting a fixed rate for their purchase, renewal, or mortgage refinance. We're seeing the impact of rising rates on the housing markets in some of the largest markets in the country, specifically Ontario and Vancouver, and we're seeing that those bubbles are deflating. Thankfully, Calgary, Edmonton, and Alberta have largely not experienced the same kind of bubble and are much less impacted by these rising rates. What we have seen is the desired effect of slowing house price increases, which creates a great opportunity for new buyers. Earlier this year, there were a few months where in Calgary, demand outstripped supply, but things in Calgary are returning to normal. In Edmonton, it wasn't nearly as dramatic, and we spoke with a lot of people at the time, especially in Calgary, that wanted to sit back and wait for this crazy market to calm down. And that is what's happening now. The rate increases are doing their job, and they're going to make homeownership more attainable for most people. On the screen here, you can see with the gray line for each of Calgary and Edmonton, the inventory level over the last year. And in the blue line is the number of sales month by month as well. In Calgary, you can see that the sales exceeded listings around March, which caused quite the squeeze. But things are getting better now, and we're seeing listings increase above sales levels again. Yes, higher rates are for a short period of time, but the cost of the higher rate is far less than a massive increase in price. So let's talk about the rates themselves. The Bank of Canada's mandate is to keep inflation near 2%. And if you've paid any attention to prices in the store or the news, you know that inflation is at a higher rate than we've seen in nearly 40 years. The bank's primary tool for managing inflation is their interest rate. But there's a limit to how effective that can be if demand isn't the driving force behind the inflation, which it largely isn't. Demand outside of real estate has returned from the disruption due to COVID, but it isn't unusually high. Best estimates today are that supply chain issues and a sick supply system are causing prices to rise and are responsible for about 60 to 70% of inflation. Add in the high cost of fuel, due in part to the removal of Russian oil from the global market, and we see that demand isn't much of a factor to the inflation. So if supply and fuel can stabilize, then inflation will stop being a thing of concern. 2022 is still a transition year from pandemic to endemic. The Bank of Canada changing rates impacts the prime rate, which is what we usually talk about. So this impacts variable rate mortgages, and since that's what most people are choosing, that's what I'm going to talk about here for the next couple minutes. Variable rate mortgages have a floating rate, but it doesn't just change at random. It's something people often are worried about. There are 8 scheduled rate announcement dates in any given year where prime can change. And you get a rate that is a specific discount from the prime rate, which stays the same for the entire 5-year mortgage term. The rate itself that you pay does change, but that's due to changes in the prime rate. So today we're on the end of June 2022. The prime rate is 3.7%, and if we assume a discount of 0.95, then the effective rate on a mortgage would be 2.75%. If prime increases in July by the high end of current estimates of maybe even 0.75%, then the prime rate would increase to 4.45, and your mortgage rate would then float with it to 3.5%. On most variable rates, you'll see the payment change when the rates change, but understanding how it changes relative to simply choosing a fixed interest rate up front is important. So let's take a look at what we can expect by taking a variable rate now and over its 5-year term. Now, I'm going to lean on the professional analysis of Benjamin Tal. He's CIBC's deputy chief economist, and he's highly respected and often very accurate in his projections. The prime rate, like I said, is currently 3.7. On July 13th, we can expect it to increase to 4.2 or possibly to 4.45%. The high end of expectations is that it will peak somewhere near 5.2%, which is 1.5% higher than today's rate. And I'm actually going to give you an example later where it shows it even higher than that and why it's still okay. So with new variable rate mortgages priced at about 2.75%, a 1.5% increase from today puts that peak at around 4.25%. And with 5-year fixed rates closer to 5% right now, you can see why really nobody is choosing those. One area where inflation has been caused by demand is the Canadian housing market, and especially Ontario and Vancouver, like I said before. But those markets have already cooled dramatically, and Tal believes that it will soon be balanced and will be followed actually by a buyer's market, which is where we have an opportunity. He tells us that we need to see inflation starting to behave and the housing market to have slowed down in order to make the point that there's no need further for the Bank of Canada's interest rates to go beyond that 2.5%, which is their rate, which is the same as a 4.7% prime rate. I can tell you that the difference, he says, between 2.5% and 3.5% is the difference between no recession and having a recession. It's as simple as that, he says. Now, to say that again using the prime rate, which again is different than the bank rate itself, he's saying that the difference between a 4.7% prime rate and a 5.7% prime rate is a recession. And we don't expect it to go beyond 5.2, which leaves variable rates closer to the 4.25% mark at their peak. Tal expects that 2 years from now, inflation will be back to 2%, and that those higher interest rates are the tool for that. So finally, with that in mind, let's briefly look at it visually. On the screen here, I'm showing with the top orange line, the rate at 4.99% over the next 5 years. That's a steady line. That's the green one. And then, that's the orange one. Then an overestimated high end on the variable rate over that same period. This projection assumes a worst case estimate and a rate high enough that Tal says it would actually cause a recession. So we can expect a fairly rapid increase in rates here soon, but not likely as high as this image shows, and have that followed by a slow decline on the back end. If the bank does push rates too high and triggers recessionary fears or a recession itself, that decline could be more rapid. So with all of that said, I would love for the opportunity for myself or my team to connect with you. So please go ahead and use the calendar link below the video, and my team and I would love to help you out.